Good morning. 4 trading days ago, Wall Street added roughly $1.5 trillion of combined market value to Alphabet, Amazon, and Microsoft on a single idea that artificial intelligence had stopped being a science project and started being durable revenue. Amazon Web Services printed $42.2 billion in the quarter, up 37%, its fastest growth in 18 quarters, and the argument looked settled. Today, a research firm published the other half of that sentence. Artificial analysis measured DeepSeek's new V4 Flash model at roughly 3 cents per task, against $3.15 for Anthropic's Claude Fable 5, more than 100 times cheaper to run. Demand for artificial intelligence and revenue from artificial intelligence are two different bets. This week, the market priced them as one. This is the Asymmetric Daily Brief for Monday, August 3rd. Here is the board and one honest caveat before the numbers. The market is still open as this is recorded, so these are intraday levels, not closes. The S&P 500 is around 7,537, up about 0.6%. The Dow is the leader, up 1.2%. The Nasdaq is the laggard at 0.5%, and that ordering is the day in miniature. This is a rotation, not a melt-up. West Texas crude is the whole story on the screen, at $79.62, down almost 6%, after the White House called off a planned strike on Iran and said talks would resume. But hold that number against its own recent history. Crude rose more than 20% across July. One day does not undo a month. Gold sits near $4,040 an ounce and is refusing to give much back. Pressured by a firm dollar, but held up by the rate path. Bitcoin is heavy at roughly 62,700, down about 0.6%, and roughly $51,000 below where it traded a year ago, and the number that governs all of the others. The Federal Reserve is at 3.5 to 3.75% after a fifth consecutive hold, and the market puts 59% odds on a hike in September. First read, everyone thinks cheap inference is unambiguously good for the hyperscalers. The tell says it depends entirely on who capitalized the compute. The reflex is intuitive. If serving a request gets cheaper, the company serving it earns a fatter margin. But hyperscaler economics here are a spread trade across time. You capitalize the data center now, and you depreciate it over 5 or 6 years against an assumed future revenue per unit of output. That useful life assumption is, functionally, a forecast of what a token will be worth in 2031. DeepSeek just published a number that makes that forecast look generous. 14 cents per million input tokens, 28 cents per million output. Cheap inference is genuinely wonderful for whoever sells applications on top. It is a live question for whoever owns an asset base underwritten against the old curve. High conviction on the mechanism. Genuinely uncertain on the timing, and I want to be honest about that. Here are the two numbers that make the first read work, and the methodology matters, so listen to it. Artificial analysis does not compare headline sticker prices per token. It measures average cost per completed task, which accounts for how much a model has to read and produce before it actually finishes the job. On that basis, DeepSeek's V4 Flash runs at roughly 3 cents per task. Anthropic's Claude Fable 5 costs $3.15. OpenAI's GPT 5.6 Sol sits at $1.86. That is a gap of more than 100 times against the frontier. Now the qualifier, because it matters and most of today's commentary skipped it. Cheapest to run is not the same as best. This is a cost result, not a capability result, and nobody is claiming these models are equivalent at the hardest work. But most commercial artificial intelligence workloads are not the hardest work. They are the ordinary middle, and that middle is exactly where a 100-fold cost gap decides who wins the contract. Alibaba, on the same day, shipped Qwen 3.8 Max at 2.4 trillion parameters with a million token context window and pointedly did not publish a per token price at all. When a company ships its largest model and withholds the price is the part it is still deciding. Second read, everyone thinks Michael Saylor does not sell. He just sold below his own cost basis. Strategy disposed of 1,638 Bitcoin for about $104.7 million at an average price of $63,957. The company's average acquisition cost across its whole position is $75,419. So that is not profit-taking. That is a realized loss taken deliberately to fund preferred dividends and to buy back $81.2 million of its own preferred shares. Holdings are now 842,138 coins. Here is why this is a mechanism and not a headline. The never sell thesis was never really a statement about conviction. It was a statement about whether the capital structure would ever force the question. A company that funds itself with preferred stock owes a cash dividend whether or not the asset cooperates. When the asset is down and the equity window is narrow, the dividend gets paid out of the asset. That is not a betrayal of the strategy. That is the strategy running in the direction nobody modeled. High conviction. Third read, everyone spent today watching a 5-day countdown on the crypto market structure bill before Congress leaves for its summer recess. Senate leadership already answered the question. Majority Leader Thune has confirmed there will be no floor vote before the recess. Prediction markets now price passage this year at roughly 28 to 35%, down from a peak of 82% in February. And the arithmetic of why is not mysterious. The bill needs floor debate, an amendment process, and a 60-vote cloture threshold, and the remaining calendar is consumed by a Russia sanctions package and a backlog of nominations. Negotiators are still stuck on 2 provisions, one on government ethics and one on stablecoin rewards. 7 Democratic senators have said the revised ethics language does not go far enough, so the countdown is not a deadline. It is theater, and that distinction is worth money. Because positioning for a legislative catalyst means positioning against the congressional calendar, and the calendar has won every round this year. High conviction. Follow the money and start with the loudest thing nobody is discussing. The Federal Reserve. Kevin Warsh's committee held at 3.5 to 3.75% on the 29th of July, the 5th consecutive hold, and hinted at a move upward rather than downward. 9 of 18 participants project a hike this year. The odds of a quarter-point hike in September stood at 59% immediately after the decision. Warsh has been explicit that there is no soft version of the 2% target. Now lay today's manufacturing data on top of that. The July manufacturing index came in at 55.6 against a consensus of 54. That is up 2.3 points and the highest reading since May of 2022. Production jumped to 58.5 from 52.2, and employment climbed back to 52.8. Its first expansionary reading in nearly 3 years. This is not a soft landing print. This is an economy reaccelerating into a central bank that is already leaning hawkish. And the mirror image of that is China, where I want to correct something that has been repeated all day. China's official manufacturing index fell to 49.2 in July, from 50.3 in June. A great deal of commentary today described that as a 4th consecutive month of contraction. It is not. That 1.1-point drop ended a 4-month run at or above the expansion line, and it is the first reading below 50 since February. Economists had forecast 50, get the direction right, and the story changes shape entirely. This is not a slow grind that everybody had already discounted. This is an unexpected step down, and unexpected is the operative word, because it is the surprise that moves assets, not the level. So the 2 largest manufacturing economies on Earth just moved in opposite directions in the same month. And the divergence is being driven by tariffs pulling activity into the American print while hollowing out the Chinese one. That is the real macro story of the day, and it was almost entirely crowded out by the oil headline. Currencies and something genuinely rare happened. The United States and Japan confirmed their first joint yen intervention in 15 years. The last coordinated action was in 2011 after the Tohoku earthquake, and that one was designed to push the yen down. This one propped it up from a 4-decade low. Both Treasury Secretary Besant and Japan's Finance Minister Katayama said they would not hesitate to act again. Bank of Japan data suggests Tokyo may have sold close to $59 billion on its own the day before the joint action. One honesty note, a specific figure of $5 to $10 billion for the American Treasury's own participation, and a report that it sold euros rather than dollars to fund it, circulated widely today. I could not independently confirm either, so I am not going to assert them. Treat both as unconfirmed. But the reason this matters is not diplomatic, and that part I can stand behind. Japan is the largest foreign holder of United States treasuries, A disorderly yen forces Japanese institutions to sell dollar assets, which pushes American long yields higher. Washington did not intervene in a currency market as a favor to an ally. It intervened to defend the long end of its own curve. And on sentiment, from market and social sentiment monitoring, commentary today clustered almost entirely on three things: the Iran call-off and the oil move, a widely shared and incorrect claim that Brent had crashed 10%, and a long-running argument about whether artificial intelligence is heading toward a recursive takeoff. What drew a fraction of that attention was the cost result, the manufacturing divergence, and the currency intervention. Notice the shape of that. The most discussed item of the day was a number that was wrong. The least discussed items were the two that actually described the constraints on policy right now. When attention and consequence diverge that cleanly, the mispricing tends to sit with the story nobody is arguing about, because an argument at least implies the market is looking. The manufacturing index at 55.6, a four-year high, with September hike odds at 59%. The bond market has spent 2 years trained on a single reflex. Bad news is good news because bad news brings cuts. That reflex requires a Federal Reserve with an easing bias. This one does not have one. It stripped the easing language out. Half the committee projects a hike this year, and the chair keeps repeating that the target is 2% with no asterisk. Into that, manufacturing just posted its strongest month since May of 2022, with employment back in expansion for the first time in nearly 3 years. If the September hike lands, it will be the first American rate rise into a strengthening manufacturing economy in this cycle. And the entire duration complex, everything that gets discounted by a long rate, is positioned for the opposite. Sectors in play: energy first. The bull case is that de-escalation is real, and the risk premium that built through July was enormous, so unwinding it is worth 6% in a session. The bear case is that Iran's foreign ministry publicly denies it is holding talks with Washington at all, and says the Strait of Hormuz stays closed. The read is that the tape is long a premise that one of the two parties is denying, with volatility near 16. The downside headline here is already public, and the market has not priced it: artificial intelligence and semiconductors. The bull case is that inference demand is compounding, and Amazon Web Services just proved it monetizes at scale at a 39.4% operating margin. The bear case is the entire first read of this brief. The price of the underlying unit is collapsing faster than the asset base can be re-underwritten. Crypto. The bull case is that structural supply is genuinely gone, with on-chain estimates putting roughly 3 million coins permanently lost. The bear case is that the largest corporate holder is now a programmatic seller at a loss, and the regulatory catalyst just slipped past its window. On this one, the bear case is simply better evidence today. On the radar, and this week has a genuinely unusual event in it. Tomorrow, SpaceX reports its first-ever public earnings. Consensus revenue is around $6.8 to $6.9 billion, against $4.7 billion in the first quarter. But the number to actually watch is the dispersion in the earnings estimates, which span from a loss of $1.26 per share to a profit of 33 cents. A range that wide is not analysts disagreeing about demand. It is analysts disagreeing about how the artificial intelligence capital spending is being accounted for. Then on Thursday, 2 days later by design, the first lockup tranche expires, releasing up to 911.5 million shares. At recent prices, that is roughly $109 to $116 billion of newly tradable stock, about 1.45 times the size of the original public offering itself. Also this week, Friday, the Senate leaves and the market structure bill's window closes. Saturday brings July payrolls and the services index, which is the second half of today's manufacturing story. And in September, the rate decision. 3 new calls go on the scorecard. 1. Before the 31st of December, at least one American frontier lab, Anthropic or OpenAI, cuts published per token pricing on a flagship model or introduces a materially cheaper flagship tier. 2. The market structure bill gets no Senate floor vote before the recess on the 7th of August. 3. Strategy reports at least one further Bitcoin disposal before the 30th of September. And the close: if the cost of running a capable model falls by 2 orders of magnitude, The technology gets more important, not less. Cheaper intelligence means more of it, in more places, doing more things. That part is not in dispute, and I do not want to be misheard on it. The dispute is about who gets paid. Falling unit costs have historically been catastrophic for whoever financed the old cost curve, and wonderful for whoever built on top of the new one. Railroads, fiber optics, airlines, memory chips. The pattern is not subtle and it rhymes every time. So here is the question worth sitting with tonight. This week the market paid $1.5 trillion for the demand. Who's going to pay for the deflation? Today's deep dive takes that question apart in full, and it is linked below. I'm Earl, the asymmetric signal, one contrarian read a day. Subscribe, research and education only, never investment advice.